So Meta's engine just generated over $23 billion in pure, unadulterated free cash.
Yeah.
But at the exact same time, the people running the company are quietly dumping their shares, and the technical charts are flashing these massive warning signs.
Right. It's a huge contradiction.
It is. So you are left asking yourself one very intense, immediate question today. Looking at the latest data, is Meta Platforms a generational buying opportunity right now, or is it actually a heavily disguised value trap?
I mean, it really is the defining puzzle in the market today. You have brilliant analysts looking at the exact same company, the same balance sheet, the same algorithmic trading patterns, and walking away with violently opposite conclusions.
Exactly, which is why we need to strip away the noise. As of yesterday, April 20, 2026, Meta is trading at $670.91, and it's navigating a period of exceptionally high volatility.
Oh, absolutely.
So our mission for this deep dive is to look at the raw data financials, technical analysis, market catalysts, the works. We want you fully equipped because we are heading right into a critical catalyst.
The Q1 2026 earnings report.
Right, coming up on Wednesday, April 29.
And, I mean, the market is absolutely holding its breath for that call.
Totally. And as a quick ground rule before we tear into the numbers, we are having a natural, objective debate of the facts here. We are analyzing the data to help you understand the landscape, but this is absolutely not financial advice.
Right. No financial advice.
We give you the blueprint, and you decide what to build with it.
Fair enough. And I think if we want to understand why the stock is behaving so erratically right now, we have to start by looking at the company's fundamental financial health.
Yeah.
Like, we need to see if the actual underlying business justifies all the drama on the ticker.
Okay, let's unpack this, because the sheer scale of the numbers in their 2025 annual income statement is, I mean, it's almost hard to comprehend.
It really is.
We are talking about total revenue sitting at an astounding $200.97 billion. And that is up 22% year over year. For a company of Meta's size, growing revenue at 22% shouldn't even be mathematically possible. It completely defies the law of large numbers.
It does. But, we have to ask why they're growing that fast at that kind of scale. And it really comes down to pricing power.
Right.
After the massive disruption from Apple's iOS privacy changes a few years ago.
Right, when everyone panicked. Yeah.
Exactly. Meta essentially rebuilt their ad targeting engine using artificial intelligence. So they figured out how to predict consumer behavior without needing to track them directly across the web.
Which is wild.
It is. And that made their ad inventory incredibly valuable again, driving up the price that advertisers are willing to pay per click.
Which translates straight to the bottom line. Net income was $60.46 billion, with earnings per share on a trailing 12-month basis sitting at $28.94. You see those numbers and you think, okay, the core business is an absolute juggernaut.
A juggernaut, yes. But the income statement only tells you what they earned over a specific 12-month window. Yeah. What's fascinating here is the balance sheet as of December 31st, 2025.
Okay.
This is the ledger that tells you how resilient the company actually is when things go wrong. They're sitting on $366.02 billion in total assets versus $148.78 billion in total liabilities.
Man, that is massive coverage. But the metric that really stands out to me, the one that proves this isn't just paper profit, is their levered free cash flow.
Right.
For 2025, that sat at $23.43 billion. And for anyone listening who gets bogged down in accounting jargon, think of levered free cash flow as the actual tangible cash left in the company checking account after they have paid the bills, paid the employees, and paid the interest on all their debts.
It's pure firepower.
Exactly.
Firepower that acts as a massive financial shock absorber. Because when you look at the stock's 52-week range, it has been a wild ride.
Oh, yeah.
They hit a dizzying high of $796.25 and plunged to a low of $479.80.
That is a swing of over $300 a share in a single year.
Which is terrifying if you are a retail investor glued to a daily chart. But those fundamental cash flow numbers are why you should care.
Right.
They prove that regardless of the panic or the euphoria on Wall Street, the underlying machine is generating staggering amounts of cash to weather the storm.
But I have to stop you there. Because if the balance sheet is throwing off $23 billion in pure cash and the growth is defying gravity, why are algorithms suddenly punishing the stock?
That's the real question.
Right. Why is it currently locked in this neutral to consolidating trend? This brings us to the dashboard, the technical analysis.
Yeah, let's look at it.
I want to look at the charts to see what the market mechanics are actually signaling, because Meta has seen a sharp recovery from its March 2026 lows. But looking at it today, I have to ask, so what does this all mean? Are we gaining real momentum or just stuck in the mud?
Well, we are stuck at a highly contested inflection point. Let's break down the key technical levels so you can visualize the battlefield here. If the stock starts to slide, immediate support, which is the floor where institutional buyers have historically stepped in, sits at $639.17.
Got it.
That is the 20-day exponential moving average, or EMA. And just below that is $630.45, the 50-day EMA.
Okay, to clarify, for anyone who doesn't stare at charts all day, moving averages are essentially the collective memory of the market, right?
Exactly.
Like the 20-day EMA just tracks the average price over the last month, giving more weight to recent days. It shows us where the current baseline of agreement is between buyers and sellers.
That is exactly how to view it. It's a safety net of recent consensus.
Yeah.
But if the stock tries to push higher from our current $670 level, heavy resistance is looming overhead.
Right, the ceiling.
Yeah. There is a descending trend line acting as a concrete ceiling at $666.26. And right above that, we hit a key Fibonacci retracement level at $697.01.
Okay, let's slow down on the Fibonacci retracement, because that sounds like Wall Street voodoo to a lot of people.
It really does.
But it's not magic, it's psychology. Traders look at the massive drop Meta took from its 796 stocks high, and they use historical mathematical proportions like a 61.8% recovery to basically guess where the stock will hit a wall.
Right.
And because millions of algorithms and human traders are all looking at that same $697 level, it becomes a self-fulfilling prophecy.
Exactly. Everyone places their sell orders at the same invisible line, creating artificial resistance. So Meta is boxed in.
Boxed in.
Yeah, trapped between the 630s and the high 660s. But the momentum indicators are where this dashboard gets truly chaotic.
Conflicting is an understatement. Look at the Relative Strength Index, or RSI. On some time frames, it is reading 86.91.
Which is practically screaming highly overbought.
Yeah.
The RSI is basically a speedometer. Usually anything over a 70 tells you the stock has run up way too fast and is exhausted. It's due for a pullback.
But then other daily readings show the RSI cooling to 73.8, still hot, but slowing down.
Right.
Meanwhile, the actual price of $670.91 is sitting stubbornly below the long-term 200-day symbol moving average of $681.04. And the 200-day average is the ultimate line in the sand for massive institutional investors.
Yeah, it really is.
Being below it means the long-term trend is still technically pointing down.
It's the absolute definition of a bearish posture.
I know, but wait. The MACD, the moving average divergence, is sitting at 13.86.
Right.
Now, the MACD isn't a speedometer. It's a measure of engine RPMs. It tracks whether the trend's momentum is accelerating or decelerating. And a reading of 13.86 indicates bullish momentum is actually building. So we have an overbought RSI telling us we are too hot, a bearish price location below the 200-day average telling us we are in a downtrend, and a bullish MACD telling us power is increasing. Like, how is any investor supposed to make sense of that?
They don't.
Yeah.
And that is the danger here. These crossed wires are exactly why retail traders get chopped to pieces.
Yeah.
When indicators conflict like this, it means the institutional algorithms are actively fighting each other. One program sees the overbought RSI and immediately short sells, while another program sees the bullish MACD and starts accumulating shares.
Creating just a mess.
Exactly. It creates a violent, choppy environment. The stock just grinds sideways, shaking out impatient humans before the algorithms finally agree on a real direction.
Man, well, if the algorithms are fighting, what are the humans doing? That sets up our next major pivot. Let's look at the smart money.
Good idea.
I want to contrast the official Wall Street analyst ratings with the actual behavior of the people running the company. So let's lay out the bullish Wall Street view first, because on paper, it looks phenomenal.
It really does. The trailing price to earnings ratio is 23.18, and the forward PE is 22.63.
For a tech giant growing its revenue at 22%, a 22 forward PE is actually incredibly cheap.
Oh, yeah.
They are trading essentially at a 1-to-1 ratio of growth to valuation. According to GF Value, which estimates the intrinsic worth of a company based on historical multiples, the stock is modestly undervalued. They peg the true fair value at $768.86, which implies a solid 14% upside from where we sit today.
And Wall Street analysts are absolutely anchored to that optimistic math. The consensus rating is a resounding moderate buy.
Mm-hmm.
If you break down the 50 major analysts covering the stock, you have 4 strong buys, 38 buys, 8 holds, and absolutely 0 sells.
Zero.
0.
Not a single analyst at a major bank is willing to tell their clients to dump Meta right now. But here's where it gets really interesting. If the valuation is so undisputedly fair and the cash flow is bulletproof, why are the executives inside the company quietly unloading their shares?
Well, that is the multi-million-dollar question right there.
Yeah.
The data is striking. We have seen $105.9 million worth of stock sold by insiders in the last 3 months alone.
Oh, wait, I have to challenge you on that. $100 million sounds like a massive fortune to you and me, but Meta is a $1.7 trillion company. Isn't $105 million just a drop in the ocean?
That's a fair point.
Aren't we overreacting to executives just, paying their tax bills or diversifying their portfolios?
In isolation, yes. Executives are heavily compensated in stock, and selling is a normal part of personal wealth management.
Right.
But it's the timing and the individuals involved that demand your attention.
Okay, how so?
Crucially, Chief Operating Officer Javier Olivan and Director Robert Kimmitt both sold significant blocks of shares just this month in April 2026.
Oh, wow.
And they were offloading at prices ranging from $626 to $667.
Ah, so they were aggressively selling right into that descending trendline resistance we talked about on the technical chart.
Exactly. If we connect this to the bigger picture, you have to weigh 2 very different realities. Is this the classic value trap?
Right.
Do the insiders see a fundamental flaw under the hood, maybe an upcoming earnings miss on April 29 that Wall Street hasn't caught on to yet? Are they quietly cashing out at resistance while the price is artificially propped up by those 38 buy ratings?
The old Wall Street adage. Analysts talk with their models, but insiders talk with their wallets. It's a huge point of tension, and that tension between zero analyst sells and the executives taking money off the table perfectly sets the stage for the massive competing long-term narratives surrounding this company.
Yeah, the bull and bear cases.
Right, because Meta is not just a social media app anymore. They are fighting a brutal multi-front war for the future of the internet. So let's look at the bull case versus the bear case.
Let's start with the bull case, which is really built on 2 staggering catalysts. First is Meta's aggressive expansion of a custom AI chip partnership with Broadcom.
Right.
Meta realized that relying entirely on NVIDIA for artificial intelligence hardware is a massive bottleneck. So they're working with Broadcom to design the exact custom silicon they need to run their specific AI models.
Vertical integration. If you control the hardware design, you lower your costs and run your data centers infinitely more efficiently than your competitors.
That's the goal. But the second pillar of the bull case is even more disruptive. There are data-backed projections circulating right now, suggesting Meta could actually overtake Google in global digital ad revenue by the end of this year, 2026.
I read that, and it represents a seismic shift. I mean, Google has held a monopoly on digital advertising for 2 decades because of search intent. You search for a plumber, they show you a plumber.
Right.
But with the rise of AI chatbots, traditional search volume is fracturing.
Exactly.
Meanwhile, Meta's direct response ad targeting on Instagram and Reels has gotten so incredibly sharp that advertisers are shifting their budgets away from Google search and pouring it into Meta.
It's crazy.
If Meta actually dethrones Google, the upside to their valuation is almost hard to calculate.
It would force Wall Street to completely rewrite the tech hierarchy.
It really would. But I'm going to play devil's advocate because every bullish dream has a potential nightmare.
Sure.
Let's look at the bear case, the downside risks that could validate those insider sales. You mentioned their custom AI chip ambitions. Well, reinventing the semiconductor wheel comes with a suffocating price tag.
Oh, absolutely.
Meta has laid out an aggressive AI capital expenditure or CAPEX plan for 2026. We are talking an estimated $115 billion to $135 billion.
That is an astronomical amount of money to spend on infrastructure in a single 12-month period.
It is. Think of it like a massive city deciding to completely tear out and rebuild its entire power grid.
Good analogy.
It is incredibly expensive. It causes massive traffic jams today, and it completely drains the city's budget. Now, you literally cannot power the factories of tomorrow without doing it, but in the short term, It is painful.
Very painful.
If Meta is pouring up to $135 billion into servers, real estate for data centers, and Broadcom research, that is cash that isn't dropping to the bottom line. It could severely compress their profit margins over the next few quarters.
And that internal margin compression is happening exactly while they are facing two massive external vulnerabilities.
Which are?
First, significant legal exposure. Meta is currently navigating over 2,400 child safety lawsuits.
Oh, wow.
Now, we are looking at this purely through a business and data lens. Regardless of how those legal battles play out in the courts, the sheer volume of litigation represents a persistent drain on corporate resources.
Definitely.
It carries the threat of massive settlement costs, but more importantly, it creates a deep reputational risk.
And if there is one thing major corporate advertisers absolutely hate, it's brand safety risk. They want their ads next to safe, predictable content, not controversy.
Precisely, which leads directly to the second external vulnerability, the impact of global geopolitics,
Okay.
specifically U.S.-China trade tensions. To understand Meta's recent explosive ad revenue growth, you have to understand the mechanism behind it. A massive chunk of that growth has been driven by Chinese e-commerce giants like Temu and Shein.
Ah, right. They have been aggressively blanketing Instagram and Facebook with ads for cheap goods.
Exactly. It is essentially customer acquisition arbitrage. They manufacture goods cheaply in China, sell them in the U.S., and use the margin to buy massive amounts of ad space on Meta.
Makes sense.
And they buy so much ad inventory that they artificially drive up the auction price for every other advertiser on the platform. This raises an important question. How vulnerable is Meta's advertising dominance if a sudden new tariff, trade restriction, or diplomatic fallout destroys that arbitrage model?
Man, if the tariffs wipe out Temu's profit margins, they stop buying ads.
Yep.
The auction demand vanishes, and Meta's ad pricing power suddenly collapses. So their biggest revenue engine is intimately tied to one of the most fragile and unpredictable geopolitical relationships on the planet.
Exactly. You have a company planning to spend money like it's invincible, relying on a revenue stream that might actually be incredibly fragile.
Okay, we have covered an immense amount of ground here. Let's pull all of this together and synthesize the outlook so you can make sense of it.
Sounds good.
If we look strictly at the short-term perspective right here in late April 2026, the technical indicators and Wall Street consensus suggest a neutral to slightly bullish stance heading into the April 29 earnings call. The absolute key to watch is that $666 resistance level. If Meta reports strong earnings and gets a confirmed daily close above that line, it breaks the algorithmic ceiling. We could see a rapid short squeeze style run toward that $700 Fibonacci level.
But if you zoom out past this year's volatility and look at the long-term horizon, the picture expands dramatically.
Yeah.
Driven by the possibility of absolute AI infrastructure leadership and the potential to dethrone Google in global advertising, the average Wall Street price target for the year 2030 sits at a massive $944.12.
Almost $1,000 a share.
Yep.
It shows that despite the chaotic technicals and the insider selling, the institutional belief in Meta's underlying cash printing engine remains incredibly strong.
The destination seems clear to the analysts. It's just a question of how violently the stock will swing along the journey.
Which leaves you with one final provocative thought to mull over as we approach earnings next Wednesday. We know Meta is planning to pump up to $135 billion into AI infrastructure this year.
Yeah.
And they are relying on their incredibly lucrative ad business to fund that leap into the future. But if those U.S.-China trade tensions suddenly flare up, and the massive ad spend from platforms like Temu and Shein evaporates overnight, what happens to Meta's bottom line just as the massive bill for those new Broadcom AI chips comes due?
Right.
Does the company power through to a $1 trillion ad monopoly, or does the engine finally flood?
That is the billion-dollar question.
It really is. Well, thank you for joining us for this deep dive. Keep questioning the data, keep looking past the headlines, and above all, stay curious. We will see you next time.